September 15, 2008 will forever be etched in history. Lehman Brothers, one of the largest and oldest investment banks in the world, filed for bankruptcy, leaving a liability of $613 billion. This event marked the largest corporate financial collapse in history at the time and symbolized the peak of the financial crisis caused by the collapse of the global financial system. But what were the causes of this global economic disaster, and what has changed in the financial system since then? The bankruptcy of Lehman Brothers triggered a chain reaction that shook markets worldwide. Numerous other financial institutions went bankrupt, were acquired by larger banks, or sought emergency bailouts from the Fed. The global financial system unraveled, millions of people lost their homes and jobs, and the world faced its worst economic recession since the Great Depression. To really get what went down in the 2008 crisis, we need to rewind a bit, specifically to the early 2000s, between 2000 and 2006. When house prices in the US were skyrocketing. It felt like the golden ticket for investments, safe, profitable, and everyone wanted a piece of it. The leading benchmark for tracking the evolution of home prices in the United States recorded an astonishing growth of 83% between 2000 and 2006. This unprecedented surge marked a turning point in the real estate market, leaving many wondering what drove housing prices to skyrocket during that period. First, the U.S. central bank slashed interest rates after the dot-com bubble burst in 2000 to 2001 and the 9/11 attacks. The goal? Get people borrowing and spending again to keep the economy moving. With super low interest rates and easy credit, everyone started buying houses, not just to live in, but to make money. From big-time investors to regular families, everyone wanted a piece of the action, thinking prices would just keep going up. This created fake demand. Tons of houses bought just to flip for profit. And, to make things worse, policies at the time made it even easier to rack up debt. Government-backed mortgage agencies were buying loans from banks, making sure the banks always had cash to lend again. The result? More loans, more debt, and housing prices going through the roof. Imagine this, it's the early 2000s, and the American dream of owning a home feels more accessible than ever. Banks are practically throwing mortgages at anyone with a pulse. It doesn't matter if you have a steady income, bad credit, or even if you're drowning in debt, someone somewhere will approve your loan. Why were people lining up for these loans? Simple, teaser rates. Picture this, you walk into a bank and they offer you a mortgage with a super low monthly payment, something like $800 for a $200,000 home. Sounds like a steal, right? What they don't emphasize is that after a few years, that 3% interest rate will skyrocket to 8% or higher. That cozy $800 payment, it's about to become a nightmare, $1,600 or more. But back then, who cared? Home prices were soaring, and the common belief was, even if I can't afford the payments, I'll just sell the house for a profit and walk away richer. Here's the kicker. The banks knew these loans were risky. They weren't naive. They were greedy. Banks saw a golden opportunity. More loans meant more fees, and they could bundle these risky mortgages into fancy-sounding financial products called mortgage-backed securities, MBS, and sell them off to Wall Street investors hungry for safe investments. The mindset was simple. As long as home prices keep going up, nobody loses. Alright, picture this. A bank gives out a mortgage to a family buying their first home. Instead of holding on to that mortgage for 30 years and collecting monthly payments, the bank decides to pull a magic trick. They package that mortgage, along with thousands of others, some good, some terrible, into what looks like a shiny, safe investment and sell it on Wall Street. The result? The bank gets its money up front, ready to issue even more mortgages. But wait, it doesn't stop there. Wall Street investors, banks, hedge funds, even pension funds buy these packages thinking they're as safe as government bonds. But in reality, they're loaded with toxic subprime loans that are ticking time bombs. Here's how it worked. Imagine taking a bunch of mortgages, some from people with stable jobs and good credit and others from people barely scraping by, and mixing them into one big investment cake. This cake is sliced into pieces called tranches. The top slices, labeled as super safe, AAA rated. The middle and bottom slices, much riskier, but with higher returns for investors willing to take the gamble. Thanks to rating agencies slapping AAA ratings on these bundles, investors from around the world bought them up like candy, thinking, what could go wrong? Spoiler, everything. The streets of many American neighborhoods, once full of life and hope, became eerie landscapes of abandoned homes, boarded-up windows, and endless for-sale signs. What caused this drastic shift? The great American dream of owning a home was swallowed by an overwhelming wave of defaults. At first, only a small fraction of homeowners began falling behind on their mortgage payments. But this wasn't an isolated trend. It spread rapidly. Soon, thousands of homes went into foreclosure, then millions. Families had to make the hardest choice, walk away from their homes or drown in debt. This sudden surge in defaults wasn't just painful for individuals, it was devastating for the market. Each foreclosure pushed down surrounding home prices, which only worsened the crisis. What made so many people default at the same time? Many loans were structured with low introductory payments that increased significantly after a few years. When the rates adjusted, monthly payments became unmanageable, sometimes doubling or tripling. As foreclosures flooded the market, home prices fell. People who were once confident they could sell their homes if they ran into trouble now faced a harsh reality. The house they bought for $250,000 was suddenly worth $150,000 or less. Their mortgages were now underwater. They owed more than the house was worth. As home prices fell, financial stability crumbled. Job losses surged, and families who might have been able to stay afloat were pulled under by the recession that followed. In the world of high finance, few names carried more weight than Lehman Brothers. Founded in 1850, it was a symbol of prestige, power, and resilience, surviving wars, depressions, and market crashes. But in September 2008, the century-old titan became the face of global financial panic. For years, Lehman Brothers thrived by taking massive risks in the real estate market. The firm poured billions into mortgage-backed securities, betting on the housing boom. But when the market turned, their strategy backfired. Big time. By mid-2008, the bank was drowning in toxic assets. Their financial statements painted a grim picture. Lehman was sitting on $600 billion in liabilities and couldn't find a way out. They needed a lifeline, desperately. But as panic spread, no one wanted to be their savior. On September 15, 2008, Lehman Brothers filed for bankruptcy, the largest in U.S. history. The number was staggering: $639 billion in assets and $619 billion in debt. The message was clear. If Lehman Brothers could fail, no one is safe. Investors worldwide scrambled to pull their money from any bank or financial institution that seemed vulnerable. Stock markets nosedived, and businesses that had no direct connection to mortgages felt the shockwaves. Trust in the financial system evaporated overnight. What started as a housing crisis in the U.S. quickly became a global economic pandemic. One moment, Wall Street was imploding, banks collapsing, markets free-falling, and in the blink of an eye, the rest of the world was pulled into the chaos. How did the crisis spread so fast? Banks and institutions all over the world had bought into the safe U.S. mortgage-backed securities. When those mortgages started failing, investors in London, Tokyo, Frankfurt, and beyond realized that they were holding worthless paper. Banks lent to each other daily to keep cash flowing. But after the Lehman Brothers collapse, no one knew which bank might be next to fail. The result? A credit freeze. Banks stopped lending not just to other banks, but to businesses and consumers. Without loans, companies couldn't pay suppliers, expand, or even meet payroll. Economies around the world started grinding to a halt. Entire governments stepped in to rescue banks and prevent financial systems from collapsing. In 2008, the UK government nationalized parts of its banking system and injected £500 billion into the market to stabilize it. The Eurozone saw widespread recession, with unemployment soaring, particularly in countries like Spain, where the housing market crashed just like in the US. Major economies like Japan and China were hit by a sudden drop in global demand. Export-dependent countries saw their growth plummet as the US and Europe, major importers of goods, slashed spending. Countries like Brazil, India, and Russia, which had been enjoying years of growth, experienced capital flight as global investors panicked and pulled their money out of riskier markets. Stock markets in these countries plunged as foreign investment dried up. This wasn't just a Wall Street crisis, it affected real people everywhere. Factories closed as orders stopped coming in. Families lost homes not only in the US, but in countries like Ireland and Spain, where housing bubbles had also burst. In Iceland, the national currency collapsed, causing food and fuel prices to skyrocket. Ordinary citizens saw their life savings evaporate. Governments around the world scrambled to stop the bleeding. The U.S. launched a $700 billion bailout for its financial institutions, known as TARP. In Germany, The government provided 500 billion euros to rescue its banking sector. China implemented a $586 billion stimulus package to keep its economy from slowing down. But these interventions came with a price: massive public debt, a wave of public outrage, and a global debate over how much responsibility governments should have for saving failing financial institutions. When the dust began to settle after the financial collapse, one thing was clear: something had to change. The system had cracked under the weight of reckless greed, weak regulations, and misplaced trust. But rebuilding it wasn't just about fixing Wall Street. It was about restoring trust for millions of everyday people whose lives had been upended. The government stepped in to create guardrails designed to stop the financial industry from spiraling out of control again. At the heart of these reforms was the Dodd-Frank Act, passed in 2010, a sweeping piece of legislation aimed at reining in risky behavior. The Dodd-Frank Act gave regulators more power to monitor large financial institutions and ensure they couldn't gamble with the economy's stability. The law required big banks to undergo stress tests to prove they could survive another financial shock. If they couldn't, they were required to restructure before disaster struck. The creation of the Consumer Financial Protection Bureau, CFPB, ensured that ordinary people were shielded from predatory lending practices. No more hidden fees, surprise interest hikes, or mortgages designed to fail. But did it work? Some praised the reforms as a crucial safety net. Others argued that they were overreaching and slowed economic growth. The truth lies somewhere in between. The crisis didn't just change regulations, it changed how people viewed the financial world. Banks, once seen as symbols of safety and reliability, became symbols of greed and betrayal. Home ownership, once the cornerstone of the American dream, was now a symbol of vulnerability. Many families, scarred by the experience, became hesitant to buy homes. Rental markets soared as people traded stability for flexibility. Trust in stocks, pensions, and 401k plans took a major hit. Millions saw their savings evaporate overnight, and many wondered, will my retirement be safe next time? Wall Street became a dirty word in many households. Images of traders celebrating bonuses while families were evicted from their homes became burned into the public consciousness. The idea that the system was rigged for the wealthy gained traction and shaped political conversations for years. Can it happen again? The hard truth: financial crises aren't inevitable, but they happen when we forget the lessons of the past. The 2008 financial crisis wasn't just a chapter in history, it was a warning, a reminder of how greed, unchecked ambition, and a failure to heed the warning signs can ripple across the globe, devastating lives in the process. Millions of people lost their homes, their savings, and their trust in the system. What would you do differently if you saw the signs today? Whether you're an investor or someone managing your personal finances, financial literacy and awareness aren't luxuries, they're lifelines. And that's it for today. Thanks for watching until the end. If you enjoyed the video, don't forget to leave a like and drop a comment below. I'd love to hear your thoughts. See you in the next one.